All right, good morning, everybody, and welcome to Dorsey's third annual Food Summit. This is Mike Droke speaking. I'm a partner in Dorsey's food, beverages, agribusiness, and cooperatives practice. And it's just great to see so many friends logging in as attendees. So, boy, it's real exciting. And in particular, a shout out to Greg Thompson, who's on the line and has been a presenter at the previous presentations. And so glad you're on the line and seeing CE and Bryn and Greg and all these great folks. And George, fun to see you all. So in any event, I've got a great group of people listening in and a really exceptional group of panelists today with some very high-level content that I know you'll be very excited to see. Next year, I hope you get to see it in person, but we do appreciate everyone's flexibility in moving to the virtual platform as we seem to be doing in today's world. So a couple of just remarks as you're getting going here. First is to know that the materials were all sent to you in a reminder email and a link to that at all of the materials and PowerPoint presentation, with the exception of some final touches to the last presentation that will be coming in as well. We also have a speaker bio sheet and other information, including some articles from, for example, our partner Nelson Dong on the topics that we'll be talking about today. So we've got just a ton of content, and as you're going through the slides, just know that the materials you've already received, and you can follow along with those or review them and refer to them later as well. Next is that, of course, we've requested CLE credit for this presentation. If you need CLE, then just go ahead and print out the attendance forms in the email reminder and send them in to Michelle Hubble, whose information is on the attendance form, and she can take care of it directly on your behalf and make the submission. For those people working in jurisdictions where we need to call out a code, we'll be calling those codes out periodically through the sessions, and so make sure you have your pen in hand and something to write on, and we'll be calling out those codes as they're occurring. We do hope that you'll be asking questions to the presenters as we go through today's program. There's a chat pane, which I'll be monitoring, and you'll see that chat pane at the bottom of your screen. The questions may come up in a subsequent slide, and so just pay attention because I might respond back to you saying, oh, got it, we'll get back to you. If you'd like to have a question be confidential, then please make a note of that. And I'll do my best also to make sure that we keep those questions confidential just in general, but if you'd like to, make sure to note that as well. So today is, we're going to start off with really an amazing kind of foundational description of what's happening in today's world. And I was fascinated in that, Rob, in particular, given the votes and such and information that's coming out of your fair city of Washington, D.C., and really interested to hear your information about what's happening, in particular in the agricultural economy. So briefly introducing our first presenter, we're very delighted to have Minnesota native, Dr. Rob Johansson, who is the Chief Economist for the U.S. Department of Agriculture. Dr. Johansson has an extraordinary background. He, after receiving his bachelor's in economics from Northwestern, then served with the Peace Corps for about 5 years, and upon return from that, obtained ultimately his PhD in agriculture and applied economics from the University of Minnesota. His research has spanned a wide range of different kinds of issues, everything from biofuels policy, water quality, regulatory economics, food security, regional and now national modeling of the food economy. So, Rob, so excited to hear from you, and welcome to the program.
Well, thanks so much, Mike. I'm just going to do a quick mic check here just to make sure you can all hear me.
You sound great.
All right, excellent. Appreciate being invited and to have an opportunity to talk about, boy, all the stuff that's going on in food and agriculture right now. Certainly a very busy time both for producers, but also certainly, of course, for policymakers. Just responding to the number of sort of unprecedented events that have occurred over the last, I'd say, a couple of years. And I'll talk about some of those, not just simply on the COVID-19 issues, but also some of the trends that are underlying our current ag production, and some more focus on food prices as well. So again, let's start off. The agriculture and food economy, what's the new normal? That's sort of the question that folks are asking now. What is the new normal? What will we look like when we come out of this pandemic in terms of ag production and food sales and interactions with consumers? And of course, we don't really know the answer to that question yet. Let's go to the next slide. I'm just going to cover these main 5 topic areas. So a little bit on the current economy, a little drill down a bit on the farm economy, talk about what we're looking at for our expectations for crop and livestock production in 2020. Talk a bit about trade. That was sort of one of the sort of positive notes coming into 2020, and I'll sort of give you an update on where we're at right now. And then to talk a little bit more about COVID-19 impacts on agriculture and what the policy response has been. All right, we can go one more. So usually when I start talking about this, I go right to the, what are the macroeconomic signals to producers and businesses? IMF is a good source of what expectations are for global growth, economic growth. And you can see here just the dramatic impact, both in April and in June, their estimates of global GDP falling into negative, certainly for 2020. Then the big question is, again, going to the, what is the new normal? So how quickly are we going to bounce back? What is it going to look like in 2021? Their current forecasts have us in global economic growth bouncing back above their last year's projections for 2021. Of course, they have other scenarios that are less optimistic as well, but right now this is their central tendency, if you will, both for emerging and advanced economies. Let's go to the next slide.
Rob, a quick question on this, just so we understand. The light beige line and the light blue line, that's what they had predicted in January, for example, of 2020, and then by April it had dropped to the darker color?
Yeah, that's right. You can see that light color there certainly is their estimate, IMF's estimate going into the beginning of 2020, and that's what we were expecting. So, general slow economic improvement compared to 2019. Then in April, they revised that down dramatically, and then again, they revised it down again in June. So right now, that June dark line is the one that we're working off of.
Got it.
So again, the next slide is looking at the United States. Of course, it's lots of different ways to show this, and I've got a couple slides here that do show just how dramatically it's affected the U.S. Economic sectors. I'm just closing one of my panes here so I can see better. Next slide. So we're over 30 million, and this just shows a longer unemployment line going back, and the shaded lines are provided by the Federal Reserve Board of St. Louis. It shows where the previous recessions were, and just 2020, just quite a dramatic outlier compared to these previous experiences that we've seen. Of course, we have seen unemployment come down a little bit here in June, down to 11.1 after reaching almost 15% earlier in May. Next slide. Another way to compare this is just to look back in history from months from the start of the recession for some of these previous economic impacts. Of course, the great financial crisis of 2007 and 8 is still in our minds. That took us, unemployment was a high for quite some time after the beginning of that event, but certainly COVID-19 stands out here in terms of claims as a percentage of the eligible population. Next slide. Of course, one thing we've seen from that, certainly early on, was when COVID was hitting not just the United States, but the whole global economy. A number of countries were looking for places to move their currencies for safe haven status, such as Japan and the US. So you see the yen actually appreciated a little bit to the dollar, but pretty much all currencies depreciated relative to the dollar in that January to March timeframe. Since March, things have equaled out a little bit. You've seen, for example, oil prices rebound a little bit, and that's helped out some of these other currencies, such as the Russian ruble and the Mexican peso. But still, we're still seeing difficulties in Argentina. Brazil is relative to last year, certainly is depreciated relative to the dollar. And that's important for egg in the United States because we are such a big exporting country. And as the dollar appreciates, it appreciates relative to other currencies. It does make it our exports a little bit less competitive on the global marketplace. Let's go to the next slide. What we've seen certainly since the beginning of the year is for most ag commodities, and if I put rice on here, it would actually go in the other direction. So actually rice has come down dramatically as well, but rice was holding strong up until recently, certainly until May. But for most commodities, we have seen a decline in their value. This is looking at futures values. And certainly the most for the livestock categories. Dairy has been up and down. Of course, as you coming from Minnesota are probably familiar with the fact that cheese prices have reached historic levels and actually have increased quite substantially. But the Class 4 price has come down almost more. Making it difficult for farmers that their dairy milk price that they receive is a combination of the Class 3 and Class 4 futures prices, and so they've actually seen a decline in their milk price as well. And I'll get to that in a second. But let's go to the next slide. Just setting the stage here, looking at specialty crops, and we've seen a big effect of COVID-19 on specialty crops. Next slide. So when we look at what's happening to, just the aggregate farm sector in the United States, we often look at net farm income. That's cash receipts minus expenditures. So that's that net farm income, blue line there. USDA will come out with its new estimate in August. So right now I'm just using an estimate that I received from the University of Missouri showing 2020 and 2021. So you can see that in January, partially as a result of the phase 1 deal with China, we saw expectations for 2020 and 2021 farm income to rise relative to previous years. Of course, we all remember back in 2013 and 2014, mostly 2013, when we had record high net farm income. We were not reaching that. We weren't expected to reach that level, but certainly things were looking better than they had over the last few years. It's been a very tough time in agriculture. With COVID, you saw the orange line there dipping down, showing the effect, the modeled effect of the loss of markets on net farm income in the United States, falling along the orange line there. The gray line there does show the relief effort that we put in place, a $16 billion direct payment program for farmers, which raised the expectations for net farm income up in 2020. Of course, there is no 2021 program at this time. So you see 2021 farm income expected down by almost 25% compared to what we were expecting at the beginning of the year. Let's go to the next slide. Another way to look at the strength of the farm balance sheet is to look at debts and assets. Here we see that actual farm debt is almost up to the historic levels that we saw back in the 1980s. Of course, that was during the farm crisis. Interest rates are much lower today than they were back then, which makes that debt repayment capacity actually improved over the last couple of years because interest rates have been so low. Debt to asset ratio, another sort of measure of farm sector health, has been steadily increasing since about 2012. It's still sitting at about 13.5%. That's on an aggregate level. That's still relatively low from a historic perspective. We do see some sectors higher than others, meaning that cotton and dairy and hogs are sitting at higher debt to asset ratios than other sectors. But generally speaking, we look at this in an aggregate, but we also dial down to those sectors of the ag economy that are having higher levels of debt relative to their assets. And they're the ones that are going to be most likely to have problems with low commodity prices. Right now, it's generally a rule of thumb that about 1 in 10 operations out there have debts that are significantly higher than this at the 40% and above. So we call those operations highly leveraged or very highly leveraged. So about 1 in 10 are in that situation, and they're the ones that are likely to face difficulties with persistently low commodity prices. And you can see that in the next slide, where we look at bankruptcy rates. Again, back in the 80s, during that crisis period, you can see that red circle showing how many bankruptcies we had per 10,000 farms in the United States, almost 25. We're down at about 3 right now. And while it has increased a little bit since that 2012 period that I was talking about earlier, it's still lower than it was in 2011 and back in 2003. So again, we're at about 3 bankruptcies per year per 10,000 farms at the moment. Again, it has been increasing a little bit, and you've seen probably some stories in the newspapers about that, but it is low from a historic perspective. Let's go to the next slide. I dig into that a little bit here with this slide, just showing the number of bankruptcies that we saw in 2019, and that's the most recent data that we have, compared to the 10-year average. So again, this isn't picking up impacts from COVID-19, but it looks at, for example, the impacts of the difficulties we had with our trading partners over the last several years due to the retaliatory trade tariffs that we've dealt with. But we've also had, of course, historically bad planting conditions in 2019 that are showing up here. So states that fall below that 45-degree line that I drew on the chart are those that had higher numbers of bankruptcies in 2019 than their 10-year average. And states that are above that line would have had fewer bankruptcies in 2019 compared to their 10-year average. So Nebraska on the far right-hand side at almost 10 bankruptcies in 2019 per 10,000, compared to their historic average of about 3 per year per 10,000 farms. So again, this just gives you an indication of which states may be seeing more bankruptcies per 10,000 over the last year or so. And those are where you're likely to see more difficulties and more reports of farm household issues and the like, as well as seeing more stories about bankruptcies being reported in the press. Let's go to the next slide. I'm going to turn now to our outlook right now for 2020 for livestock and crops. If we go to the next slide, you can see here, this is our current forecast for the number of acres that farmers are going to be planting in 2020. Of course, last year we had a lot of declines in planted acres because, particularly in the upper Midwest area, there was severely wet and cold planting conditions last spring, which delayed a lot of planting and in fact prevented a lot of planting. So we had what's called historic prevent plant last year. We knew we were going to recapture those acres this year, so we saw more acres planted to corn and soybeans at 92 million acres and 84 million acres, roughly, up again 10% for soybeans and 3% for corn. We go to the next slide. Just give this a try. Now, Mike, if you can, there should be a little toggle here on the bottom. If you can click that, it should make those graphics animate. I don't know if it's doable in this technology, but let's see if I don't know if you have that ability to click in there should be a.
Yeah, I'm trying here. Sorry.
There you go.
There we go. Okay.
I'll tell you what this is reflecting here. This is what we often look at when we're trying to estimate what farmers are going to do with their acres. Are they going to plant them to corn or plant them to soybeans? That's obviously a different question in California than it is for Minnesota. But in the Midwest, of course, in the Corn Belt, you know, most producers are going to plant a lot of their property to corn and to soybeans. And so we look at what's called the soybean to corn price ratio, and that's just reflected here over time. In January here, you can see corn prices relative to soybean prices. We're keeping that ratio at about 2.3. That's about average for long term. So there you would expect, and that's what farmers were saying at that time. They were going to plant 97 million acres of corn and about 83 million acres of soybeans. Now you saw that dramatic increase, which occurred at the time of COVID-19, at the time that ethanol facilities were shutting off purchases of corn, the time that livestock and hog operations were having a hard time making ends meet. And you can see how corn price relative to soybean price fell dramatically, and you saw this ratio strengthen, meaning that the soybean prices were higher relative to corn prices. And that's why we saw, even though producers said that they were going to plant 97 million acres of corn back in March, by the time that we got their actual plantings reported in at the end of June, we saw only 92 million acres of corn. So essentially we lost 5 million acres of corn somewhere, and that actually translated into higher corn prices on the stock market, or sorry, on the commodity markets. So anyways, that's just one thing that we were looking at. If we go to the next slide and we look at what our projections are for some of these commodity prices, and these are Farmgate prices, so average prices that a farmer will receive. We're projecting that wheat prices are unchanged from 2019. Of course, we've seen a decline in corn prices related to both ethanol and livestock that I mentioned earlier, down to $3.35 a bushel. It was down to $3.20 and below earlier in the year, as I was mentioning. They have strengthened a little bit when we saw that producers only planted 92 million acres. Soybean prices about what they were last year. Again, cotton prices also what they were last year at 59 cents a pound. Very, very low historic price for cotton. So cotton producers are certainly feeling a squeeze right now on their margins. Rice prices have come down, but they are still relatively high historically. So at $12.7 per hundredweight. We go to the next slide. We look at beef and pork and dairy as well, and broiler production. So the red numbers there just give you an indication of what we're projecting for 2021. So the red means that it's going to be, those would be record levels if realized. And we are actually seeing record levels of meat production in 2020, as well as milk production at 221 billion pounds of milk being produced in 2020 expected. So again, just showing steadily increases in meat and dairy production in 2020 and 2021. We did see a drop off a little bit in beef production in 2020 compared to 2019. And that's somewhat related to some of the issues we've had in the processing facilities. But we expect that to come around in 2021 with higher levels of exports to a lot of our trading partners, both in North America as well as Asia. If we go to the next slide. One thing that is driving meat markets, and I'm just checking on timing here. I'm going to speed up a little bit. I'm about halfway through my PowerPoints. We see that African swine fever has been affecting pork production in Asia and notably China. So they have been increasing their purchases of pork, both from the United States, Brazil, and the European Union. But if you look at the next slide, it just shows how China's meat imports have been ramping up in 2019 and 2020 since the advent of that African swine fever that we saw has been driving up imports of not just pork, but also beef and chicken as well. And they're becoming a larger share of the global meat import market as a lot of those Chinese households move into the middle class. And that's one thing that's been driving our expectations of growing trade in the United States. If we go to the next slide. One thing that did affect in Minnesota, you're very familiar with how the meat packing industry was affected by COVID-19. We did see a drop off in our slaughter capacity, both from the pork side, but as well as beef side as well, and in some cases, some of the broiler facilities. Through, this is mid-July, we're still seeing some locations with reduced swine slaughter, normal slaughter at 33 locations. And this isn't all the facilities, these are just the larger ones. Just the story here is that we had ramped up to meet some of that Asian demand for pork. And so going into the year, we had increased our expectations of pork production by 5%. So a lot of animals were headed to the packing facilities when COVID-19 affected the labor supply and the ability to keep those plants running at full speed or even at idled speed. And so that has caused a dramatic backup in the animal and meat packing sector. If we go to the next slide, that'll show what prices did. You can see here, this is the spread between the box beef price and the dressed steer price. And same would hold for pork, just showing that the wholesale price for beef shot up to record levels compared to the price that producers were receiving for their animals. Again, just related to the decline in capacity at those slaughter facilities. It's coming back to normal, but something we're tracking. If we go to the next slide, we'll show you that this is our expectations for global production, up for wheat, corn, soybeans, rice, down for cotton, and up for sugar. So again, just bouncing back from 2019. 2019 was kind of a low year for some countries, particularly the United States, and we're expected to see global strength in production in 2020. That should push down a little bit on prices. If we go to the next slide, this is our expectations for U.S. exports of ag products. Again, the February and May estimates shown there. We're going to have an August one coming up shortly, but sitting at about $140 billion. Now, again, this doesn't include the fourth quarter, which would reflect higher levels of exports to China. And we can talk a bit more about the phase one deal if we have time in the question and answer. Next slide. If we look at another beneficial trade agreement that we've seen that's starting to take effect, and that's the new USMCA agreement that took over for NAFTA. We are seeing an increase in exports going to Canada and Mexico in these goods over the same time period compared to 2019. So again, another positive signal that we are looking at coming into the year. Next slide is, talks a little bit about a resource if folks are interested in looking at how our reports correspond to that phase one deal. Some of the details are available there. I don't know why the slide's a little blurry, but apologize for that. If we go to the next couple slides here, it just shows what our levels of exports are to China. Of course, we're tracking this very closely. So the red is the current year. So we're still down in soybean exports compared to the 5-year average, but certainly above what we were last year. We're above for corn, pork, and wheat. We go to the next slide. Just shows that we're also showing improvements in cotton, beef, sorghum, and rice. Of course, China being the largest rice producer doesn't import a lot of rice. But certainly we did have some SPS agreements built into that phase one deal that should improve imports or exports of specialty rice to China. All right, let's turn to some policy effects. When I think about COVID-19, this is generally what we've seen, and there's a longer term impacts as well that I'm not able to talk about at this point in time. But short run, you know, we saw these supply chain disruptions. We saw a little bit of evidence of that. Higher retail prices and lower Farmgate prices, which led to domestic farm policy and consumer support. So we did see both direct payments to farmers as well as the increase in movement of commodity directly to consumers through the food box program. Medium run, we're expected to see demand loss. So again, just thinking about those Chinese households moving into the middle class, buying more meat. We're likely to see a slowdown in that because of the slower economic growth, not just in China, but in India as well as other Asian countries. So again, and some changes in consumer demand. We'll talk about that in a second. Let's go to the next slide. So in the US, we certainly saw a change in consumer demand. Hotel and restaurant spending fell off the map in terms of how much folks got purchased food from those facilities compared to the retail. Retail is still up, but not like the spike that we saw in March, still up about 10% compared to previous year. And we're starting to see retail and hotel spending return. Next slide just shows that drove up the consumer price index for a lot of food products. These are for purchase at home consumption. So the CPI is just reflecting about a 5% food inflation rate right now. So that will affect certainly low-income households the most. Let's go to the next slide. One interesting thing that we have seen with this disruption caused by COVID-19 is this prices moving in opposite directions. I alluded to that a little bit with that spread on the beef, box beef to live animal price. We see it here on the cattle price received by producers compared to ground beef that at the retail level. So ground beef prices per pound increasing dramatically. This is the most recent estimate. I've got them on an annualized basis. And certainly cattle prices showing the decline in the price per hundredweight that producers are receiving. The same holds true for dairy, hogs and pork, and wheat and bread. Same story there. Again, this raises questions about where that margin is going. Retailers are certainly charging consumers more for a lot of these products, and producers are certainly not seeing a lot of the returns from that. So again, this is something that researchers will be looking at probably at the University of Minnesota, as well as companies, private companies are certainly looking at this data as well. Let's go to the next slide. All right, talking a bit about farm policy. So normally we would be talking about the Farm Bill, and this is just my normal Farm Bill slide showing that about 80% of the Farm Bill goes to SNAP and food and nutrition programs. But of course, we're not in a normal year. If we go to the next slide, this just shows how we've been characterize farm spending. This isn't including the SNAP portion of the Farm Bill, the nutrition part. This is just the on-farm payments, and we can see how that's, the black line there is in 2018. That's when we started putting in place programs to deal with the trade issues that we had with China, Canada, Mexico, and Europe. So we started building out the MFP program, the Market Facilitation Program, and then of course this year we've got the $16 billion in the Coronavirus Food Assistance Program, CFAP. All right, next slide. The MFP program, for those of you that have been following this, this is the program we put out in 2019. It's sitting at about $14.5 billion in expenditures right now to help offset trade damages from those retaliatory trade tariffs. These are the states and the recipients of some of those dollars. The CFAP program, as I was mentioning earlier, again, the Coronavirus Food Assistance Program was $19 billion. 3 of that was for direct, for moving product directly to consumers from the farm in the food box program, but 16 billion was in direct program commodity support to producers for a number of products, livestock, row crops, and specialty crops. Next slide. And we look at the CFAP program spending on the next slide. You can see that it's sitting at about, of that 16 billion, through the 6th of July, we are at about 5.5 billion having been spent. We expect that to continue to roll out. In fact, folks can still sign up for that program through the end of August. So we do expect to continue to see outlays in that program for the next couple months. Ending slide, just wanted to point out, for some of you may have been to our Ag Outlook Forum at the USDA, which we hold in February. We do have a lot of information on our website, including up-to-date information on the Ag Outlook Forum. This is from last year, so upcoming will be the 97th annual Ag Outlook Forum. It's a great place to meet folks and talk about ag and food. So right now, of course, we don't know what stance we'll be in this area come February. But of course, we would love for it to be in person or some sort of hybrid. But I'm sure that as we're experiencing today, a lot of these conferences are being held virtually, and we may end up doing that this year. I think it can be done very effectively, and let's see how effective I was this morning and see what kind of questions I got.
Fantastic, Rob. And wow, I'll give you one moment to take a breath. That's a lot of information in a short time frame, and we really appreciate it. We had a couple of questions actually as they're coming in here. One was related actually to the slide and the description about the on-farm bankruptcies. And then I was kind of waiting the question was, do you expect that number to increase or decrease, which is, the question that was asked by Allison. But in addition to that, can you give any context to that related to specific types of crops or regions or the like?
Well, it's a great question. The data that we're getting for those bankruptcies comes from the court system, and it doesn't include a lot of information that we can dig out on, the types of assets, the type of operation it was. Although we have tried to engage in several research projects to look at that information, because folks are always really interested in that, and they ask that question, what kind of operations are. One thing that we've started doing, which I showed here, was splitting out the states. So normally we would just show the aggregate number, but when we start looking at, at states and comparing it to previous years, and we can start to tie that together, is that the dairy, the dairy sector has been under a lot of pressure over the last couple of years. So dairy states may show higher numbers of bankruptcies. And that's sort of what my prior expectation would have been. So I guess short answer to that question is, it's a great question. I get asked it all the time, and I really have a very unsatisfying answer to that part. Going forward, in terms of COVID-19 impacts on the farm sector, I would definitely say that we've seen a lot of stress on the farm sector. We've tried to respond with the programs that we're putting in place. The Farm Bill, of course, has safety net programs as well for farmers to help them through difficult times. That being said, I think it's undoubtable that we would likely see additional bankruptcies as a result of coronavirus above and beyond what we normally would have seen. So again, I would expect that to continue to tick up unless we see prices recovering in 2020, either from getting coronavirus addressed through vaccines more quickly than we expected, and having countries' economies rebound. Or again, if, as we all know, if there's a major weather disruption globally, whether there's a drought in South America, Australia, the Black Sea area, or in Europe or the United States, or a flooding event, those will affect production as well and tend to push up prices as well. Of course, as prices recover, that will ameliorate those bankruptcy rates.
So Pam asked an interesting question. She asked if you could speak to the short-term or medium-term effects brought on by COVID, in particular related to specialty crops such as almonds, peaches, raisins, and the like.
Well, it's another great question. Specialty crops, of course, are a sector of the ag economy that have been growing steadily, comprise about 30% of farm receipts, but that historically hasn't participated all that much in USDA programs. So we don't have as much data on specialty crops as we do on corn, for example, and that's not all that surprising. So when we look at the impacts on specialty crops of a shock like this, it's a little bit harder to trace through the system. But I can say this: when we put together the coronavirus food assistance program, specialty crops was and you'll see in publicly reported information that the payments to specialty crop growers has been very low compared to what our estimates were. Now, why is that? One is because specialty crop growers don't have that kind of relationship with our county offices that livestock and row crop producers do. So they're not unfamiliar with where to go, who to talk to, what kind of information they need to show in order to participate in our programs. So that's one reason. Secondly, a lot of specialty crop producers there's a lot of big ones and a lot of small ones. And so the larger operations are being affected by the payment limit, adjusted gross income eligibility requirements that we have for these programs. The smaller operations may just find that their expected payment is not worth their effort to go into the office and provide all that information. So a couple of just sort of contextual points there. We do know that coronavirus affected specialty crop growers significantly in a couple ways. One is they lost a lot of their markets. So I showed you that graph of how spending at retail went up through the roof, and at restaurants and hotels fell through the floor. So, you know, when specialty crop growers are selling their commodities to restaurants, directly to restaurants or to hotels, all of a sudden they didn't get paid for those shipments, or those markets completely dried up and they had to go out and search for a new market. Of course, grocery stores like buying from the same person and the same, you know, quantities and the same sort of, I guess, packaging that they need for putting on the shelves quickly. All of that takes time, and it's not easy to redirect immediately from a restaurant, for example, to a grocery store. We saw the same in dairy, for example. You can't sell a huge block of butter that would normally go to a restaurant. You can't sell that in the grocery store. You need to repackage it somehow, and that caused a lot of issues with the dairy sector. So that's one issue. Another big issue with specialty crops is they're oftentimes contract growers. So they'll be like, for example, potato growers will sell a lot of their commodity for the frozen market to several large processing operations, and they have a contract for selling those processors a certain amount of potatoes every year. Now, of course, what they're seeing now is those processors are telling them that their contracts are 50% smaller than they were the previous year. So all of a sudden, those potato growers are saying, well, what do I do with all this land that I was going to put in potatoes? So that's another issue. Now, I know we're running short on time, so
I got two other quick questions that I think would help really cap it off. So the first comes from Dave Townsend, who asked if you could talk about any effects of COVID-19 showing up in the data regarding U.S. exports to China, and any kind of expected compliance with the phase one deal. So that's the first question. And then the final question from Fred is, do you see any market forces at work that might help equalize the difference between producer and retail prices?
Yeah, great questions. I'll try and give you a quick answer to both. So let's talk about China first. So it was, you know, we did see record levels of pork exports to China throughout the coronavirus throughout, you know, since this January. So it's been, our exports of pork to China have been continually increasing. Of course, we've seen the Chinese demand very strong there. So we did not see a drop off in pork exports to China, surprisingly, given the effects that we saw in some of those packing facilities. So we have been managing to continue to sell to China. China, of course, themselves, their demand got knocked down because they, of course, suffered from coronavirus as well. They've recovered to a certain degree. The big question marks loom regarding fall, both in China as well as other countries, in terms of whether there'll be a sort of a rebound in infections. So that has affected China's ability to meet their phase one requirements. What do I mean by that? They had committed to purchasing from the United States nearly $40 billion worth of agricultural products, some seafood included in that, as well as some ethanol included in that, some other products. But by and large, a very large amount of exports were expected to flow to China in 2020. We have seen an increase relative to last year, but not at the levels that we would need to see in order for China to meet their commitment. We do expect exports to ramp up fairly dramatically in the fall as we harvest our crop. And of course, soybeans is being our largest export to China. We expect to sell a lot of soybeans to China this fall. Those don't show up in our estimates yet. They will show up in the August estimates. So we'll see what they look like when they come out. Again, I think it's understandable that China has been dealing with a lot of these issues, just like other countries. And so, of course, you know, we would like to see that commitment held, and we expect them to meet it. That being said, we'll wait to see what the data shows. Of course, there's a lot of other parts of the phase one deal, not just purchase commitments. And of course, we're moving forward on those SPS types of agreements as well to facilitate our exports of specialty crops and livestock and row crops to China. Second question was market forces ameliorating sort of that shock to the the growers, the Farmgate prices being knocked down so much by loss in demand. Yeah, we have seen that, and you could see that a little bit from that spread between the wholesale prices and the Farmgate prices in the beef sector. Same's holding true for pork. I would say, though, that overall demand globally is down for agricultural products just due to the fact that economic growth is down. That's going to continue to push down on prices. So I don't really see a price improvement for producers until sort of the global economy has a chance to rebound hopefully in 2021. At least that's what the IMF is showing, and we're hoping that holds out to see that would push up prices in addition to the beneficial trade agreements that we have with Japan, and Mexico, Canada, and China. So hopefully I'll end it there on a positive note at 9:46.
Fantastic. And you did end it on time and on a positive note. So, Rob, thank you so much I'm still, figuratively digesting the information, but what a great kickoff and summary of where the farm economy and agricultural economy is at in today's world, and to some degree where it's going. So thank you, and greatly appreciated. Keep up the great work.
Very good. Looking forward to seeing you all in person at some point in time.